Hi everyone, Ray Olson here. I'm back to share some quarterly insights on current market performance and current economic conditions. Here's what we saw in the third quarter of 2022. Global stock and bond markets continued their downward trends from the previous quarter. The S&P 500 index extended its decline from the first half of the year by closing the quarter with its worst month since March 2020. Bond markets also continued to decline, fueled by the expectation of continued rate hikes and elevated inflation readings. Growing concerns that central banks around the globe will be willing to push economies into recession to stop inflation resulted in negative performance for the quarter across all major asset classes. For the quarter, U.S. stocks lost 4.5%, international stocks lost 9.2%, and emerging stocks lost 10.8%. U.S. interest rates increased during the quarter as the Federal Reserve raised the target range of the federal funds rate from 1.5% all the way to 4%, by the way of 3 rate hikes of 0.75% in July, September, and November. However, markets have currently priced in the expectation of additional rate hikes during the remainder of 2022 with an implied target range of between 4 and 4.75% by end of year. Now, let's talk about our economy. The final reading for second quarter annualized GDP was negative 0.6%, meaning economic output contracted for the second consecutive quarter in 2022. And while 2 consecutive negative readings historically precede the official declaration of a recession, the National Bureau of Economic Research, the organization responsible for declaring recessions, has yet to do so. Fortunately, third quarter annualized GDP increased at a rate of 2.6%. The unemployment rate ticked up slightly to 3.7% in August. This coincides with a tight labor market that might be showing early signs of loosening. Headline inflation, as measured by the CPI, closed out August at 8.3%. This has remained well above the Fed's long-term target rate of 2%, which explains why we've had such interest rate hikes. What about financial markets? Domestically, all size and style equity categories were down during the quarter. International developed stocks markets also posted negative performance, and for U.S. investors, returns were negatively impacted during the quarter by the strengthening U.S. dollar. The economic uncertainty caused by the continuing war in Ukraine, high inflation, and the Fed's ongoing rate hike campaign caused U.S. and global bonds to lose more than 1% for the quarter and move in the same direction as stocks. A diversified index mix of 60% stocks and 40% bonds would have lost 5.1% during this quarter. And remember that Buckingham's evidence-driven investing portfolios are strategically invested with a focus on long-term performance objectives. Portfolio allocations and investments are not adjusted in response to market news or economic events. However, we evaluate and report on market and economic conditions to provide our investors with perspective and to put portfolio performance in proper context. And finally, The good news is we have built an investment plan to weather storms such as these. Remember, you're better off having a logical approach, looking at the evidence, staying diversified, and focusing on the long term. Thanks for listening, and I will see you next quarter.